Okay, we have now seen a purchase investment decision, sort of a straightforward decision on whether or not we should undertake a new project. Now, in this section, we're going to add a few wrinkles and look at this in the context of a replacement decision. And so we're talking about an environment where we already have a piece of equipment, and we're considering whether to replace that piece of equipment before the piece of equipment wears out entirely, or whether to continue using the old piece of equipment. And in many ways, this is certainly more complicated. There are only a few ways in which it's more complicated, but it is more complicated. My guess is you're going to need to review this material more than once. You probably want to be sure you print out the PowerPoint slides, go through it, see sort of the whole picture, go back through it again. You might need to do this 3 or 4 times to get comfortable with how this replacement decision is made. So we're talking about, in this case, an investment decision where there's some new piece of equipment, in this case a new technology. We're going to look at whether or not we should buy a new computer, even though the old one is functional still. This is going to include several additions to the basic investment decision that we saw in the previous section. To begin with, we are going to have to consider whether or not, well, if we undertake the new project, we're not only going to buy a new machine, we're going to sell the old machine. And that will figure into the cash flows. The sale of the old machine is going to have tax consequences. It's going to have tax consequences in 2 areas. One, the machine itself, the gain on the machine would be taxable. If there's a loss on the sale of the machine, we're going to get a tax deduction, which is a cash inflow. So that's one consequence of selling the machine. The other is our depreciation is going to change. We were depreciating under one schedule. We're going to replace that with a different depreciation level. So we're gaining depreciation on the new machine, but we're giving up depreciation on the old machine, and so we're going to have to look at the net change in depreciation and figure out what the tax consequence of that is going to be. So sort of 2 pieces of the tax consequences: the taxes on gain or loss and the tax change due to changes in depreciation. We could do this analysis using 2 different methods. One is referred to as an incremental analysis. We could do a total analysis or an incremental analysis. In the total analysis, we would examine the cash flows from buying the new machine, and then we would examine what our cash flows are from keeping the machine that we've got, and we would just subtract one for the other, and that would be our net present value. In this case, we're going to use incremental analysis. We're going to look at the changes that occur to various cash flows, and after we've looked at all those changes, we're going to add up the changes. The basic assumptions that underlie this, I've listed out here. We own a 2-year-old computer. That computer's worth $37,600 today. The original purchase price was $120,000, and we were depreciating the old computer using 5-year Mackers. So there's some life left. There's accumulated depreciation that's occurred, and when we sell this computer, if we sell it, if we choose to sell it for $37,600, then we're going to need to figure out the gain or loss, which is going to require that we know what the adjusted basis, what the remaining basis is in the computer, and so that's how we'll find that gain or loss. We also see here in the assumptions that a new computer would cost $180,000, and that would also be depreciated using 5-year Mackers. Now notice that the first year, and 5-year Mackers means there's 6 years of depreciation. Notice that the old computer has 4 years of depreciation left. The new computer would have 6 years of depreciation left. The benefits and costs from this we're estimating to be $42,000 benefits and cost savings, $42,000 a year. So if we have cost savings of $42,000, maybe we're using less electricity. It requires less time from technicians, whatever. If there's a cost saving, that's the same thing as having income. Reducing costs. Remember Ben Franklin, a penny saved is a penny earned. Well, $42,000 saved is $42,000 earned. In any event, we're going to treat this $42,000 as though it's revenue. Reduced cost is equivalent of revenue. The tax rate is 35%, and our discount rate is 10%. So we've got quite a few assumptions here. Let's look at how we go about applying these. To start with, let's look at, if we sell this old computer, what are the cash flows associated with the sale of the old computer? Well, the original price on the computer, the original price was $120,000, so that's our depreciation base, and we've had 2 years of depreciation that have already been taken, so we've deducted in the first year, this has already occurred, we deducted $24,000. Okay, and in the second year we deducted $38,400, so total accumulated depreciation is $62,400. The remaining basis, or the book value, we can find by subtracting that accumulated depreciation from the original purchase price of $120,000, and that gives us a book value of $57,600. Now, we were told that we can't sell it for $57,600. That's just what it sits at on our balance sheet. It's only worth $37,600. So our book value is $57,600. Our sale price is $37,600. That means that we're going to have a loss. We're going to have a loss on this of $20,000. So that's the tax loss. Now, and when I say tax loss, that's not the tax, that's the loss that we're going to use to calculate the tax effects. Our tax rate was 35%, and so the tax benefit, if we have a tax loss, the tax benefit is $7,000. In other words, if we sell this at a loss, we can claim a refund of $7,000 on our taxes, or we can claim a $20,000 loss that will reduce our taxes by $7,000. Therefore, this tax benefit is effectively a cash inflow. That $7,000 is a cash inflow. So, what are the total cash inflows from selling the old computer? Well, we've got sales proceeds of $37,600. That's what we can sell it for. But we also have a loss that allows us to reduce our taxes, and that tax reduction is $7,000. So together, the cash inflows from this sale are going to be $44,600. So we sell it for $37,000, but we actually get more cash than that because of the tax deduction that is going to come from the loss. If we had sold this piece of equipment for more than the book value, then the tax, we wouldn't have a tax benefit, we would have a tax cost, and that would reduce the cash inflows from the sale. So what's the price of our new computer? Well, we're going to look at the net price. The new computer would cost $180,000, but we're not going to buy the new computer unless we're also planning to get rid of the old one. So we'll buy a new computer up for $180,000. We would sell the old computer, generating cash inflows of $44,600. Okay, so the net cost of the new computer is $135,400. Let's turn now. We'll put that aside. We're going to come back and get that a little bit later. All right, that's the investment amount that we just saw. Let's put that aside and look at what's going to happen to our cash flows. And we're going to, what we care about in this case is after-tax cash flows. So one of the elements of that is depreciation, right? We're going to look at depreciation, the tax benefits from depreciation, but as we mentioned earlier, we not only have depreciation on our new equipment, which would be line 2 here, and that's our 6 years of depreciation. If we total this whole thing up, we get the value of our new piece of equipment, which is in aggregate $180,000. So this would be the depreciation over 6 years. The depreciation that we're giving up on the old equipment is $23,040 in the first year, and that's shown in red here. So we're going to give up some depreciation. We net the two. That's the incremental depreciation, the extra depreciation expense that we're going to be able to take if we buy this piece of equipment. The tax rate is 35% in column 5. So in column 6, the reduction in taxes that we will see because we have increased our depreciation expense is listed here in column 6. So that's the reduction in taxes from depreciation alone. Now, in addition to the depreciation, we're going to have some other, so in addition to the tax savings from depreciation, we have some other cost savings. We're told that every year the cost savings is the equivalent of $42,000, but those cost savings are like revenue. They're going to increase our income. They're going to result in higher taxes. We're going to have to pay tax at 35%. We'll get to keep 65 cents on the dollar of that revenue, or that cost savings. So our after-tax savings is only $27,300. So every year we're going to have that $27,300. So our yearly savings our savings every year, okay, is going to come in two forms. The after-tax savings from just the cost reductions and the increased tax benefit or the decreased taxes from the depreciation, from our change in depreciation. So we'll pull all that together in this final schedule. Each year we're looking at the tax shield that we calculated from depreciation in column 2, the after-tax cost savings that we calculated in column 3. We just add those together. We get a total benefit that occurs every year, and now we find the present value using the present value interest factor over here. So in column 5, we're using present value interest factor, so we're finding the present value of every one of these items in column 4. Column 6 is now the present value, and the total present value of all the inflows, the incremental inflows, the incremental benefits, is $150,000. What does it take for us to get that $150,000 in incremental benefits? Well, we had to pay $135,000 net for the new computer. So we're going to get $150,000 in benefits over the next 6 years. The cost is $135,400. That means our net present value, the NPV, right? It's net because it's the benefits minus the investment cost, is $15,500. The NPV is positive, and that means that we should undertake this investment. So what does that mean? It means to this point, we haven't actually sold the computer, the old computer, or bought the new one. Right? We've just been analyzing what would happen if we did that. So now we know if we do that, our NPV will be positive. It will increase the value of our firm. it'll increase the wealth of the shareholders, and we should undertake that project. So we've got a positive NPV. We move forward with the project.